Good evening, students. Welcome to the session. Have you solved the sum that I had given you in the last class? You had enough days to solve the question. I'm hoping that all of you have gone through the question and solved it. Yes or no, students? Yes. Good evening, Namrata. Good evening, Prerna. Yes, have you solved the question, students? What we were discussing in the last class was the MAT provision, right? We were discussing about the minimum alternate taxes, and I had told you about the adjustments to the book profits that needs to be made in order to compute the book profits for the purposes of the MAT. And as if you remember, I had told you the MAT is not applicable to the foreign company which is resident of a country with which India has a DTL and it does not have a P, or it is a resident of country with which India does not have a DTL but it is not required to maintain the books of accounts in India under the companies it is not required to register under the Companies Act. And third, the foreign companies whose total income solely consists of the presumptive profits under 44BB, all these sections, and the income has been offered to tax in accordance with the rates under those sections. And then we had discussed certain adjustments to the book profit. So yes, have solved the question. Let's solve it together. Good evening, Viraj. Okay. So what was the question? ABC Private Limited, incorporated on 1/11/2023, is engaged in the manufacturing of footwear and has set up a factory in Northeast. It has reported the net profit of 80 lakh. The following items have been credited or debited. The contribution to the Research Association, which is eligible for deduction under 35(1)(2) of rupees 2 lakh. Expenses towards in-house R&D, depreciation, royalty, STCG, and other information. So we had computed the normal total income under the normal provisions, which was coming to this amount. And we had applied the 25% tax rate, assuming that the turnover is not applicable for the financial year 21-22, as it was not incorporated in that year. So we have taken the 25% tax rate over year, isn't it? And we have calculated the surcharge of 7% and cess of 4%. Alternatively, I had also calculated the tax at the rate of 30% as well, right? And with respect to the royalty income, the 10% was beneficial. So we have taken that for the royalty income, isn't it? So one second, I think there is some mistake over here. One second. In the calculation of the tax, we have also considered the capital gain as well as the 10% royalty which is there. So this will not be the answer. We'll change it here. We'll change it over here. So there's some error over here. So let's compute the tax first under the normal provision. So royalties is going to be taxed at 10%, taxable under section 115 BBF at the rate of 10%. So 10 lakh on that, 10% is 1 lakh, right? Then short-term capital gain. What is the short-term capital gain on? So it is mentioned over here on the listed equity shares. So 15% on the short-term capital gain under section 111A at the rate of 15%. So 10 lakh into 15% is 1.5 lakh. On balance income at the rate of 25%. So 125 minus 20 lakhs, 105 lakh into 25%. 26.25. 28.75, surcharge at the rate of 7%, and cess at the rate of 4%. So the net tax payable will be 28.75 plus 7% and plus 4%. 31.993. Alright. So this is going to be the tax payable under normal provisions. If I do at the rate of 30%, then it comes to 31.5. This comes to 34. And after surcharge and cess, it comes to 37.8356. Yes, students. Sandhya, 40A3, you are saying. So the cash expense disallowed is 11,000. This is in cash, right? Into 25 employees into, okay, this should be not 12 months. This should be only, yes, you are correct, only 2 months. Yes. So this should be only 2 months. You are correct, Sandhya. So this also will change, and accordingly our tax computation will also again will change. So 11,000 into 25 into 2 months is 5.5 lakh. So this will be 5.5 lakh. So again our tax computation will undergo the change. So then surcharge will not be applicable only because this is 97.5 lakh minus 129,600. This will be 96,20,400. So surcharge will go away. So your surcharge will not be there if the income is changing. Right? So on 76,20,400. On the balance income, this will be 25% coming to 19.05,100. Okay. So total tax will be 2155,100 plus cess of 4%. This will be 2241,304. And if you calculate the 30% tax rate, this will be 2286,120 and 4% on this will be 2377,565. Yes, any other doubt in this, in the normal provisions? Okay, I think most of you have not done it only. This is really bad. See, if you are not going to do it, then you will have doubts and then you will have the questions around it why we did something. Because it's possible that some kind of minute error would have been committed in this. Right? Okay. So now this is as per the normal provisions. Now we'll calculate the MAT. So MAT is going to be applicable. So I'm going to calculate the MAT on this. So tell me, first we'll start with the net profit as per the P&L account for the MAT. So what is the net profit? 80 lakhs. Fine. This is going to be 80 lakhs. Then again, we'll go back to this. It says contribution to the research association eligible for deduction under 3512 of rupees 2 lakh. Under MAT, this will be allowed or this will be disallowed? Yes. Under MAT, this will be allowed or this will be disallowed. Yes, students. Faster. Under MAT, this is allowed or this is disallowed? Disallowed? No, Sandhya. This is allowed. Only if there is a specified adjustment under the MAT. You have to carry out only those adjustments. So yes, Jigar, you are correct. This is allowed under the MAT. So this is allowed under the MAT. So no effect here. Then expense towards in-house R&D. Again, this is allowed. Depreciation as per books of accounts. Depreciation as per books of accounts. What would you do under MAT? Allowed, disallowed? Yes. Depreciation as per books of accounts. Yes, Jigar, correct. So depreciation as per books of accounts is allowed. Yes, Sandhya, correct. Only the revaluation should be excluded. Otherwise, we will consider under MAT the depreciation as per books of account. We will not take the depreciation as per the Income Tax Act under the MAT calculation. So this will also be allowed. Then royalty received from patents developed and registered in India, rupees 10 lakh, expenses and rupees 1 lakh. What will be the implication under MAT? All of you please answer. Be with me. Yes. What will happen in this particular situation? Faster, students. Yes, Sandhya, correct. So this should be deducted from the net profit and the expenses should be added back. So this is a specified adjustment. So we will add the royalty expense 1 lakh less royalty income 10 lakh. Fine. Yes, Jigar. Jigar, it will not go to another head, but this particular income which is chargeable under 115 BBF will not be subject to MAT. So MAT will be subjected on all the other income, but not 115 BBF income. Are we clear? So this will continue to be taxed under the normal provisions as it is taxed. The MAT will not be applicable. Therefore, we are adding the expenses back and reducing the income. Fine. Then STCG on transfer of listed equity shares, rupees 10 lakh. What will be the impact of this? Yes, fast. Any impact on this? No, Sandhya, that's not correct. That is not correct. Yes. Anybody else? Go back to your MAT adjustments and see what it says. Yes, students. What will happen to the STCG? Faster, students. Have you not revised it? So STCG would not be having any impact because if you look at the specified adjustments that I gave you for the book profit, is there any provision to add back the STCG over here? The answer is no. There is no way the STCG has to be added back. So STCG will not have any impact over here. Are we getting that? So we will not add back this over here. Okay. So no impact. Fine. Then depreciation as per income tax, again no impact. ATJJAA, again no impact. So under MAT, this is the only adjustment that is there. So 80 lakh minus 9 lakh, right? So 80 minus 9 is 71 lakh. MAT at the rate of 15% will be 10.65 lakh and cess at the rate of 4%. This will give us 11.076 lakh. Now this is obviously higher than your normal tax liability. Your normal tax liability is coming to 22 lakh 41,000, which is higher than the MAT. So MAT not applicable as normal tax greater than the MAT. Okay. Now we have tax under section 115 DAB, the optional scheme. So again, let's start with a net profit of 80 lakh. Then contribution to the research association. What will happen to that? Yes. Contribution to the research association. Yes. No, Jigar, that's not correct. What will happen to the contribution to the research association? Yes, Sandhya, correct. We will add it back to the net profit because this is not allowed as the deduction. So this will be added back. How much it is? 2 lakh. Then expense towards in-house R&D. What will happen in that situation? Expense towards in-house R&D. Yes, students, faster. Yes, Namrata, you were correct. In-house R&D. Yes, Mohammed, correct. Yes, Namrata, correct. So in-house R&D is allowed. Sandhya, in-house R&D is allowed as the deduction. So let me take you back to the basic concepts lecture. What did I tell you over here? Contribution to the university, research association, scientific research, statistical, that is not allowed. What is allowed is scientific research related to the business by one own self. So in-house R&D expense will be allowed as the deduction. The in-house R&D expense will be allowed as the deduction. So this will be allowed as the deduction. So you can write allowed under section 115 BAB. Depreciation as per books of accounts, obviously we will add it back. So add depreciation as per books of accounts 40 lakh. Fine. Then royalty from patents registered in India. What will happen to that? Yes, Jigar. If it is not in-house, it will not be allowed. If it is contribution to any research association, that will not be allowed. Yes, faster. But at what rate you will tax it, Jigar? Yes, Namrata, depreciation we understood, but what about the royalty under 115 BBF? Yes, faster please, students. I'm not getting the enough responses. So, royalty, if you remember, I had told you let's go back to the basic concept class. And if you remember, income which is taxable at special rates will continue to be taxed at the special rate at the rates specified under the Act. So for 115 BBF, if it is taxable at a special rate, it will be continued to be taxed at that rate, and 115 BAB will not be applicable. So we will reduce the royalty income, which is 10 minus 1, 9 lakh, because this is chargeable at the special rate of tax of 10%. Clear? So 115 BBF will be applicable. Sandhya, is it clear? The royalty income will be added back, so reduced, and the royalty expense will also be added back, because if the expense you will claim in relation to the income, right? And under 115 BBF, you have the gross basis of taxation. So you cannot say I'll claim expense over here against the normal business income and royalty I'll charge it separately. So that is not possible. You have to claim the expense in relation to the business that you're carrying out. Yes, yes, clear, correct, Namrata. Then STCG, STCG of 10 lakh. Yes, what will happen to STCG of 10 lakh? Yes, trigger, correct. Same treatment as royalty. So it will be continued to be taxed at a special rate. So STCG 10 lakh. Okay. Then other information for the assets, what will be the depreciation here under the 115 BAB? Calculate the depreciation for me. Yes. So here the depreciation was 29 lakh under the normal provisions. Here what will be my depreciation, students? Yes, Sandhya, very good. 13 lakh. So here the depreciation will be 13 lakh and not 29 lakh. Why? Because Jigar, how 28 lakh? No. The additional depreciation is not allowed, Jigar, under 115 BAB. Only the normal depreciation is allowed under 115 BAB. So therefore, less depreciation as per Income Tax Act, only 13 lakh and not 28 or 29 lakh. Additional depreciation is not allowed, Jigar. Right? Clear? Now what about 80JJAA and the disallowance under 48(3)? Yes, Namrata, correct. What about 80JJAA and the disallowance under 48(3)? Yes, Shigar, correct. That's the only deduction which is allowed. Yes, Sandhya. 80JJAA allowed. Yes, Geeta, correct. Okay, so 48(3) disallowance we will add back. What was the disallowance under 48.3? 5.5 lakh. This will give me my business income, which is 80 plus 2 plus 40 lakhs minus 9 lakh minus 10 lakh minus 13 lakh plus 5.5 lakh. So 95.5 lakh. Then royalty 10 lakh. Then under the head capital gain, my STCG is 10 lakh. So this will give me my total income of 115.5 lakh less deduction under chapter 6A 80JJAA. What is the deduction amount? The deduction amount is 129,600. So my total income will be 114.204 lakhs. Now what will be the tax under section 115 BAB at the rate of 22%? Tax under section 115 BBF will be at the rate of 10%, which is 1 lakh. Tax under section 111A at the rate of 15%, 1.5 lakh. So on the balance income, you have 20.72488 lakh. So your total tax comes to 23.22488. Now what will be the surcharge and the cess over here? What will be the surcharge over here? Yes, students. What shall be the surcharge? What shall be the surcharge over here? No, Geeta. Yes. What shall be the surcharge? Faster, students. Yes, students. Yes, Geeta, you are correct here. It should be, sorry, 15% and not 22% tax rate. Sorry, my mistake. This should be 15%. So 114.204 minus 20 lakhs into 15%. This should be 14.1306 lakh. Calculate the total tax for me. And what is the surcharge? Yes, what is the surcharge? Yes, students, faster. What is the surcharge? Yes, correct. Yes, Jigar. Yes, Namrata. Correct. Yes, Geeta. Surcharge will be 10%. So this comes to 16.6306. And then on all the income, the surcharge will be 10% plus cess of 4%. So this will give me 19.025 lakh. On even 115 BBF and 1118, the surcharge will be 10% irrespective of the income threshold. Yes. Are we clear? So now the tax is 19.025. And if you look at this tax, this was 22 lakh, whereas this is 19 lakh. So it is beneficial to opt for section 115 BAB. Here, MAT not applicable in case of section 115 BAB. Fine. The MAT will not be applicable in this case. Are we clear? I'm giving you 1 minute time to go through the question in entirety and let me know if you have understood it well. Yes. 1 minute time to go through it in entirety before we proceed further under MAT. Are we clear with this question? Yes or no? Yes. Yes, students. In-house R&D is allowed under 115 BAB, Sandhya. Yes. In-house R&D will be allowed. Okay. Let's solve one question particularly on the MAT provision from your module itself. Okay. So let me put it before the question on MAT so that MAT becomes very thorough to you. Are you able to see the question? Okay. Yes. So Sona Limited is a resident company and earned a profit of 15 lakhs after the debit or credit of the following items to the statement of the P&L. Items debited are provision for the loss of subsidiary, provision for doubtful debts, provision for income tax, gratuity, depreciation, interest to financial institution unpaid before filing of return, penalty for infraction of law. An item credited are profit from the unit established in SEZ, share in income of an AOP as a member, income from units of UTI, long-term capital gain on sale of building. Depreciation includes 1,50,000 on account of revaluation of fixed assets. Depreciation as per income tax rules is 2,80,000. Brought forward business loss is 10 lakh, which includes unabsorbed depreciation of 4 lakhs. The AOPs of which the company is a member has paid the tax at MMR. Provision for income tax includes 45,000 of interest payable on income tax. Compute the MAT. Yes. Yes, Namrata, I will summarize it, the earlier question. So, for the benefit of all, till you start solving. So, whenever in the exam, you read the question, read the last line of the question carefully, what you are supposed to do. Whether you are only required to compute as per the normal provisions and you are required to ignore MAT and the 115 BAA or BAB provision, or you are required to only compute the tax. If it is said only compute the tax, that means you will have to do the MAT. You will have to also evaluate the optional tax which is there under 115 BAB or 115 BAA. If it is said ignore that, then you will have to ignore that. Here we are required to compute all three. Under normal provisions, the normal principles of the PGBP will apply. Under the MAT, only the specified adjustments are required to be added or reduced from the book profit. Under the 115 BAB, you have to go as per 115 BAB. Under 115 BAB, for example, the deduction under 35 which is available is not allowed. But if your expense is towards the in-house R&D, if the expenditure is towards the any revenue expense for the research and development, for scientific research, any capital expenditure which has been incurred, that will be allowed under 115 BAA and 115 BAB as well. Are we getting that? And any special income which is charged at a specific tax rate, that will continue to be charged at that specific tax rate only under 115 BAB. But the surcharge of 10% will become applicable. Further, additional depreciation is not allowed under 115 BAA and 115 BAB. So that you will not take into consideration. 80JJAA is allowed under both, under normal as well as under 115 BAA and 115 BAB. Is it clear, Namrata? Okay. Now tell me, for this, here it is only asked about MAT. So what about the provision for the loss of subsidiary, whether allowed or whether disallowed under MAT? Provision for loss of subsidiary. Thank you, Jigar. Provision for loss of subsidiary, allowed or disallowed. Yes, Geeta, it is disallowed. Very correct. So provision for the loss of the subsidiary, as I told you, any provision which is not for the ascertained liability is disallowed under MAT. So this will be added back. Okay. Provision for doubtful debts. Yes, Jigar. Yes, Sandhya. Yes, correct. Provision for doubtful debts. Yes, Geeta. That is also disallowed. Provision for income tax. Yes, Geeta. Correct. Again, disallowed. Provision for gratuity based on actuarial valuation. Yes, Namrata. Yes, Jigar. Correct. No, Namrata. Yes. Provision for the actuarial valuation. Income tax not allowed, Jigar, yes. Jigar, yes. provision for actuarial valuation. Yes, Namrata, you're correct. It is allowed because it is ascertained. Yes, Sandhya, very good. So this is an ascertained liability because it is based on the reasonable report. The actuarial valuation is the expert report which based on the past experiences will suggest that what should be the gratuity which would be payable. So this is the ascertained liability. So therefore allowed. So no adjustment. Depreciation. Now there's an adjustment for the depreciation which says the depreciation includes 1,50,000 on account of revaluation of fixed assets. Depreciation as per income tax rules is 2,80,000. Yes. So what about depreciation? Yes, Sandhya, only the revaluation depreciation is not allowed. But for the purpose of the presentation, what you will do is you will add 3.6 lakh and you will reduce 3 lakh 60 minus 1 lakh 50,000. So 2 lakh 10,000. So in effect, 1.5 lakh gets added. So you have to make the presentation in this way. You will have to add back the entire depreciation and then reduce the depreciation excluding the revaluation. Clear? Yes, Jigar. Yes, Geeta. Correct. Fine. Geeta, 2,80,000 will have no implication because this is as per Income Tax Act. So no implication for this. Okay. So this will not have any impact. Okay. Also, there was one more adjustment for the provision for income tax. It says provision for income tax includes 45,000 of interest payable on income tax. So what about interest on income tax? Whether allowed, disallowed? Namrata, you will not add back revaluation. You will make the presentation in this manner only. You will add back entire 3 lakh 60 and you will reduce 2 lakh 10. This is how you will make the presentation for the exam because the math calculation allows for this kind of presentation or provides for this kind of presentation. So you don't need to make the net effect. You have to make this presentation. Yes, Sandhya, you're right. Interest on income tax also is not allowed. So that is a specific disallowance even for the interest on income tax. So this is not allowed. Fine. So this is not allowed. Then what about the interest to the financial institution which is unpaid before the filing of the return? Yes, interest to the financial institution which is unpaid before the filing of the return. Yes, Geeta, correct. So interest to the financial institution which is unpaid before the filing of the return is disallowed under section 43B under normal provisions. Under MAT, there is no adjustment for that. So yes, Namrata, yes, Geeta, you are correct. Yes, Jigar, it is unpaid, but that is disallowed under 43B under normal provision. Under MAT, there is no adjustment for that. So Jigar, under MAT, this will be allowed. Are we clear? So this is allowed under MAT. Allowed under MAT as no specified adjustment. Okay. What about penalty for the infraction of law? Yes. Yes, Namrata, right. It is not allowed under normal provision because not paid till the due date of return of income. Viraj, no. Yes, Geeta, correct. So penalty for the infraction of the law, Jigar, is allowed. Viraj, it is allowed. Mohammed, it is allowed. Because if you look at the specified adjustment that I have written over here, I have nowhere written about the penalty. What it just says is the income tax is disallowed. And income tax includes the interest, surcharge and cess. The penalty is not a specified adjustment. So though the penalty is disallowed under section 37 of the Income Tax Act, but under the MAT, it is not a specified adjustment, so that will be allowed. Only the adjustments which are specified under the MAT, only that you will disallow. Yes, Geeta, correct. Yes, Namrata, yes, Sandhya, right. So, both of this will be allowed under the MAT as no specified adjustments, though disallowed under normal provisions. Are we clear? Yes. Then items credited, profit from unit established in SEZ. Profit from unit established in SEZ. Yes, Namrita, correct. You have to just remember what are the adjustments, and that also are not difficult to remember because it is mostly the provisions which are disallowed and then the, of course, revaluation and the special income. Yes. What about the share of the profit? Geeta, no, that is not correct. No, Mohammed, that is not correct. Yes, Geeta, you are correct. Yes, Sandhya, correct. So basically, the profit from the SEZ, again, there is no specified adjustment for that. So that will not be excluded while computing the book profit. So no adjustment under MAT as not specified. Then share in the income of an AOP as a member. It is written the AOPs has paid the tax at MMR. So what will be the impact of this? So this will be reduced from the MAT because if you remember, yes, Geeta, you are correct. I have told you over here in the specified adjustment list, share of the AOP, member on AOP or BOI where no tax is payable under 86. So if the AOP is paying the tax at MMR, there is no taxability in the hands of the member under 86, and therefore that share of the member will be excluded from the MAT. So we are going to exclude this from the MAT. Reduce as no tax payable by member under section 86. Income from units of UTI. Yes, Sandhya, you were correct. Namrata, is it clear? It is to be reduced. Yes. Income from units of UTI. Yes, Geeta, correct. Here there will be no effect because there is no specified adjustment for this. Long-term capital gain on sale of building. Long-term capital gain on sale of building. Yes. Yes, Geeta, correct. So here also there will be no effect. Then finally last adjustment, brought forward loss as per books of account is 10 lakh, which includes the unabsorbed depreciation. Sandhya, the capital gain will not be excluded. The capital gain will not be excluded. If you remember, even in the last sum, we had not excluded the STCG under 111A. Yes. So even though it is at special rate trigger, but if there is no specified adjustment for that, we will not exclude it. Only the incomes which are taxable at special rate, which are specified, only that have to be excluded. Yes, Jigar? Yes, Namrata, correct. So what about the brought forward loss and the unabsorbed depreciation? Yes, students. Faster, please. I need the answers. Yes. Yes, Geeta, correct. Yes, Namrata, correct. So what is the lower of both? Yes, Geeta, correct. So basically, we have to take the lower of the both, which is rupees 4 lakh. Let's say, for example, if the question would have said that this particular company has gone into the IBC proceedings, then you would have taken the aggregate of both, which was 10 lakhs. Okay. But here, lower of 6 lakh or 4 lakh, which is 4 lakh. So this will be reduced. Is this math question clear to all of you? Yes, Sandhya. Yes, Namrata. Correct. Are we clear? Yes or no? Yes. Fine. Let's proceed further. Now the next part is going to be the MAT in the case where the IndAS adoption is made. So MAT in the case of IndAS company. Fine. Now the companies which are adopting the IndAS, they have the books of accounts which are different from the normal companies because they have the applicability of the IndAS. Right? So for them, the map specifies the different set of adjustment apart. So these adjustments will obviously be made. But in case of a companies whose financial statements are drawn up in compliance with the IndAS, the following additional adjustments will be made to the book profit. So these adjustments will be made any which ways, but there shall be the, you can write like this, additional adjustments to book profits for IndAS compliant companies. Okay, for IndAS compliant companies. What are the additional adjustments that one needs to make for these companies? So let's try and understand for that. Now, if you have the book profit, which is prepared in accordance with the IndAS, are we getting that? If it is the book profit where you have the in accordance with the IndAS, then there is something called as other comprehensive income. What is other comprehensive income, students? You know the IndAS more than me. So what is other comprehensive income? Yes. What is other comprehensive income? Faster. Yes, students, faster tell me what is other comprehensive income? Yes, Namrata, you're right. But can you tell me exactly what is there under other comprehensive income? Yes, anybody? Yes, faster. I'm not getting any answer. So, other comprehensive income, which is there, is basically the head where you have the items that will be permanently recorded in reserves and will never be reclassified to the P&L. So OCI includes certain items that will be recorded in reserves and will not be reclassified ever to the P&L account. Now, these items will be included in the book profit for the MAT purposes. So, under OCI, there are certain items which are not reclassified to the P&L, but these will be basically going to the reserves. So I will add all the amounts credited to the OCI and will less all the amounts debited to the OCI. Because as per IndAS, these items will be going to reserve and will never be reclassified to P&L. For example, changes in the revaluation surplus of the plant, property or equipment, gains and losses from investments in equity instruments designated at fair value, remeasurements of the employee benefit plans. So these items are basically never reclassified to the P&L and they go to the reserves. So what I will do is, here you can write down first adjustment is in respect of the items that will never be reclassified to items which are part of OCI. Items part of the OCI that shall never be reclassified to P&L. So add all the credits less all the debits. Okay? Yes. So basically, where the IndAS compliant company is there, so you have to increase all amounts credited to the OCI under the head items that will not be reclassified to P&L, and you will reduce all the debits to the OCI, the items which will not be reclassified to the P&L. However, no adjustment will be made for revaluation surplus or gain or losses from the equity instruments which are designated at the fair value, because these will be charged to the P&L in the year in which the actual profit is realized. See, there is no provision for the notional losses under the MAT. So even if under the OCI the notional losses are recorded, you will not carry it to the P&L by way of the adjustment. Are we clear? So no adjustment for revaluation, no adjustment for the revaluation surplus or notional gain or losses from the investments designated at fair value. Designated at fair value. The adjustment shall be made in the year. The adjustment shall be made in the year in which asset is actually disposed of for the actual profits. Are we clear? Yes or no? Okay. The next adjustment for the MAT companies is demerger, is in the case of the demerger. Give me a minute. I'll just write it like this. Revaluation surplus. Okay. Next is for the demerger. Now, in the case of demerger, the amounts which are debited to the P&L on distribution of non-cash assets to the shareholders, or the amounts which are credited to the P&L on the distribution of non-cash assets, that shall be adjusted. So basically, IndAS 10 provides that any distribution of the assets other than cash, which is non-cash assets to the shareholders, shall be accounted at the fair value. Now, the difference between the book value, the carrying value, and the fair value is taken to the P&L. Right? Now, again, this is a notional loss. So, therefore, we have to adjust for that under the VAT. So, again, when, let's say, for example, the reserves will also get debited because this is a deemed dividend, right? Distribution of the assets to the shareholder is basically considered as deemed dividend under section 222C also, or 222A also, right? So therefore, this difference will again be taken to the P&L. So this will be excluded from the book profit. So just write it over here. Add or less amount debited or credited. Add amount debited on distribution of non-cash assets to the shareholders, less amount credited on distribution of non-cash assets to the shareholder. Okay. So this is for the demerger. Clear? Now this is for the company which is demerging. In case of the resulting company, again the assets and the liabilities which are received by it are recorded at the values which are different from the values which it was recorded in the books of account of the demerged company. So any change in the value which is there shall be ignored for the purpose of computation of the book profit. Okay. So in case of the resulting company, if there is any gain or loss which is being credited, that also shall be ignored for the purpose of the resulting company. Then third one is the transitional amount. Now when the IndAS compliant company adopts for the IndAS, in the first year of the adoption of IndAS, the company will have to prepare the financial statements of that particular year in accordance with the IndAS with a comparative financial statement for the earlier year as well. So therefore, a company is required to make the adjustments in the opening date of the comparative financial year as well, so as to make the comparison possible. And it has to present as a reconciliation between the earlier accounting standards and the IndAS amounts, both on the opening as well as on the closing date. So therefore, for the book profit computation of the year of adoption, the amounts adjusted as on the opening date of the first year of adoption shall be considered. So basically, let's say the company adopts for IndAS from 1st April 23. It will prepare the financial statements as per IndAS for 23-24. Now, as on the 1st April 23-24, when it is preparing the financial statements, it has to also prepare a comparative of previous year 22-23. So it has to make the first time adoption adjustments for the difference between the AS and the IndAS. Now these first time adoption adjustments shall be considered for the purpose of computing the VAT under the book profit. That is known as the transitional amount. That is known as the transitional amount. Now how will you calculate the transitional adjustments? So basically, the transition amount is the amount which is adjusted in the equity, in the other equity, basically in the reserves, on the convergence date when you are adopting it for the first time. Convergence date is the first day of the year in which you have adopted the IndAS. So those amount where there is a difference between the AS and the IndAS, you are adjusting in the reserves. That amount is known as the transition amount. So all of those amounts, other than the amounts which are adjusted in OCI, so that is taken as care as a part of the OCI adjustments, obviously. Right? And the OCI amounts that can be reclassified to the P&L, that will not be any which ways taken into consideration. Only the OCI amounts that are not reclassified to the P&L, that are taken into consideration. The revaluation surplus has to be ignored, even under the transitional amount. The gain or losses from the investments in the fair, which are of the investments designated at the fair value, that is to be ignored. So other than that, the adjustments which are arising on account of transition to IndAS from the existing AS is required to be recorded in the other equity as on the date of the convergence to IndAS. Now, 1/5 of that transitional amount is allowed for the period of the 5 years. Is to be allowed for the period of the 5 years. Okay, so just write down over here. The transitional amount, 1/5 for amount recorded in other equity as adjustments from adoption of IndAS adoption of AS to IndAS. Okay, so 1/5 for 5 years from the year of convergence. From the year of the convergence. Okay. Yes or no? Is this clear? Now in this also, the amount adjusted in the other equity will exclude amount adjusted in other equity, exclude the capital reserves and the securities premium. Shall exclude the capital reserves and the security premium. Okay? Excluding the capital reserve and the security premium. Fine. Then you have to make certain other adjustments. Okay, you have to make these certain other adjustments. Excluding OCI items reclassified to P&L. These shall be considered in the year of reclassification to P&L. So I'm not talking about not reclassified to P&L. Not reclassified we have already considered above. This is OCI items reclassified to P&L that shall be excluded. Then OCI items not reclassified to the P&L. So the adjustments which are recorded in OCI and which will never be reclassified to the P&L shall be included in the book profit, which is what we have already covered above. Okay. So that shall be already, which is we have discussed over above. So what is to be excluded over here is, here we need to exclude those adjustments which are recorded in the OCI, those adjustments which are recorded in the OCI, which will not be reclassified to the P&L, which will not be reclassified to the P&L. Are we clear? So that is to be basically excluded. However, we will not include the changes in the revaluation, the gains and losses from the investments in equity instruments designated at the fair value. So, other than changes in revaluation, surplus of plant, property and equipment. Second, gains and losses from the investments and equity instrument. Designated at fair value. Third, remeasurements of the defined plan. Okay, so this will be excluded. So under the IndAS, the entity uses the fair value, right, in its opening IndAS balance sheet as the cost for the plant, property and equipment or any intangible asset, right? In such cases, for the purpose of computing the book profit, in case of any revaluation of assets, to record it at the fair value, you need to revalue the assets from the cost to the fair value. So any impact on the revaluation shall be ignored for the purpose of the computation of the book profit. So the adjustments which are there also taken into the other equity in the retained earnings, that also shall be ignored. Similarly, depreciation also shall be ignored because we will record the actual losses on the disposal of the plant property or equipment. Similarly, for the investments, also it has to record it at the fair value. So any kind of adjustment which is made in the retained earning, that also needs to be excluded. Fine. Then the last one, so these are to be excluded. Okay. Last one, the last adjustment for the MAT compliant companies is gain or loss on disposal of the foreign operations. Add or less. Gain or loss on disposal of foreign operations. So any entity which has the foreign operations whereby it is required to have the translation differences of the foreign operations. So that shall be excluded because that will be again recorded at the time when the actual losses arise on the disposal. Okay. So that shall be excluded from the book profit. Clear? Any doubt, any questions as far as this is concerned? We are going to solve the question on that. Namrata, only the items not reclassifiable are to be adjusted. Yes, Namrata, we will do the example for this. The transitional amount basically is, Namrata, that the amount we will require to make the adjustment to do the adjustments which are required to be done to comply from the AS to the IndAS. So we have to do the opening balance sheet also as per the IndAS. So those amounts which are recorded in the opening balance sheet may have to be changed to comply with the IndAS. So those are the transitional amounts. So we are going to solve a sum on this after the break. Okay, let's take a break of 10 minutes and then we get back and start solving the question on the IndAS compliant companies. Okay, let's take a break. So students, I have put the question before you. Basically, this is what you have to solve now. The first point is ABC Limited, an Indian company engaged in the pharmaceutical formulation in Tamil Nadu, started adopting IndAS with effect from 1st April 2021. The following particulars are furnished for 31st March 2024. Book profits after adjustments of all items specified under 115JB amounted to 52.626 lakh, except for adjustment of the brought forward losses for the year ended 21st March 2024. It should be. The brought forward business loss as per the books of accounts for financial year 2021-21-22 is given. The business loss of 4.6 and 1.75 have been deducted while computing the book profit under the 115JB for financial year 21-22, 2021 and 21-22. Okay. So the particulars of OCI for the year ended again 31st March 2024, rupees in lakhs. OCI that may be reclassified to the PNL. Deferred gain cash flow hedges, deferred cost of hedging, comprehensive income from the discontinued operations, the exchange differences of the foreign exchange operations, and the total is given basically, which is given, right? 3.30 and 9.70. Then you have the OCI that will not be reclassified to P&L. So changes in the fair value of equity instruments, deferred gains on cash flow, deferred gains on the cash flow hedges, deferred cost of hedging, share of OCI of other associates, remeasurements of post-employment benefit obligation and revaluation surplus. The transition amount as on the convergence date stood at 52.50 lakh, including capital reserve and adjustment of 4.5 lakh relating to the transition difference in foreign operation. NCLT has admitted the application under Section 7 of IBC made by the financial creditor against the company for initiation of the insolvency proceedings on 31st March 2023. The income tax liability is rupees 9.20 lakh. Yes. So we'll start with this particular question. Yes. So computation of the MAT liability is what we have to do. Now the book profit we will start with. So your book profit is how much? Book profit is 52.26 lakh. We'll start with that. Or we'll write here net profit as per PNL 52.56 lakh. Okay, 52.26 lakh, not 56, it is 26 lakh. Then you have the brought forward business loss as per books of accounts, rupees in lakh. What will be the impact of this? What shall be the impact of this? So here it is given that the book profit is 52.26 lakh except for the adjustment of the brought forward losses. Now the brought forward losses are given for financial year 2021 and 21-22. The business loss of 4.6 lakh and 1.75 lakh have been deducted while computing the book profits under 115JB for 2021 and 21-22 respectively. So what will you do in this case? Yes, come on, tell me. Yes. What will you do in this case? Faster, students. Yes, I'm awaiting your answers. Yes, students, please faster. What should we do in this particular situation? Not getting any answer. Are you with me? Yes. So, students, if you read the last adjustment over here, that the company has gone for the IBC, for the insolvency proceedings. So, will that have any implication over here? Yes. Will that have any kind of implication over here? It has gone for the insolvency. Yes. So if you look at it, see, the company has the business loss and the depreciation. So here, the business loss and the depreciation both needs to be claimed, as I said, for a company which has gone for the insolvency proceedings. Yes, Namrata, you are correct. So under 115 JB, the lower of the business loss or the unabsorbed depreciation is allowed. We saw that in the last question. But in case the company has applied for the corporate insolvency process under IBC and that has been admitted by the adjudicating authority, the total of the brought forward loss and the unabsorbed depreciation shall be allowed from the book profit for the purposes of the MAT. Since the business loss has already been deducted in the earlier years against the book profit, so this year we will only allow the unabsorbed depreciation. Are we getting that? So the business loss has already been computed, taken into consideration. So here you can write down less the unabsorbed depreciation for a company which has made the application under IBC and same has been admitted, the aggregate of UAD and the business loss shall be allowed as the deduction against the book profit. Since business loss have already been claimed against past years' book profits, UAD shall be allowed against the book profits of the current year. The UAD shall be allowed against the book profits of the current year. Yes. So therefore, in this case, Namrata, both will be allowed, but we will only allow the claim of this 4.9 plus 2.20. 7.1. Fine. Okay. Next adjustment is the particulars of the OCI for the year ended 31st March 24. OCI that may be reclassified to the PNL. OCI that may be reclassified to the PNL. What will be the implication of that? Yes. OCI that may be reclassified to the PNL. So this was one of the exam question, students. Yes, tell me what shall be the impact of this? Yes, students, faster, please. Yes. No, Jigar. Yes, Namrita, you are correct. So that shall be considered in the year of the reclassification. So yes, Namrata, you're absolutely correct. Jigar, we will not reduce it. As I said, the items that will be reclassified to the P&L will not be considered over here. So just write it down. Items reclassified to P&L shall be considered in the year of reclassification. So as I said, only the adjustments which are specified have to be considered. So for this, there will be no effect. So no effect. Fine. Now OCI that will not be reclassified to PNL. So in this case, what will you do? OCI that will be not reclassified to the PNL. Yes. Yes, Mohammed, correct. But will you add all the credits and less all the debits over here, Mohammed? So students, as I said, here I have written no adjustment for revaluation surplus or notional gain or losses from the investments designated at the fair value. So basically, here you will not make any adjustment for this. So no adjustment for the investments designated at the fair value, revaluation surplus, no adjustment, and for the rest of it, you will make the add or less. Are we getting that? So for the deferred gain on the cash flow hedges, share of the OCI of other associates, remeasured of past and post-employment benefit obligation, All of that you will consider, but for the rest of it, you will not consider. So this and this we will not include. So what we will include is only this. 4.10, 7.25, 3.20, and 4.45. So basically, add amount credited. In that, we will consider deferred gain on cash flow hedges, 7.25, share of OCI of other associates, 3.20, remeasurements of past employment, post-employment benefit obligation. How much is it? 4.45. So you will not consider the revaluation surplus for the assets unless amount debited to OCI not reclassified to P&L. This is amount credited to OCI not reclassified to the P&L. Fine. Here, deferred cost of hedging. This is 4.10. Okay. Next adjustment is the transition amount as on the convergence date stood at 52.50 lakh, including the capital reserve of 8 lakh and adjustment of 4.5 lakh relating to the transition difference in foreign operations. Yes. What will you do for the transition amount? Yes, students. So as I said, the transition amount is the amount which is adjusted in the other equity, excluding the capital reserve and the security premium reserve. So you will exclude the capital reserve here. So this is the amount which is basically taken into consideration to adjust your opening balance sheet. So you will have to make a comparative financial statements under IndAS. So this is your first year of adoption of IndAS. Now, how will you give the comparative amounts? Because last year you would have adopted AS. This year you are going as per IndAS. So you need to make the changes in the last year balance sheet basically to align the disclosure with the IndAS. So the differences which will arise, that is the transition amount. And that you will adjust in other equity, basically in the reserves and surplus. In that you will not include the capital reserve and the security premium reserve. Now, under the transition amount, the amount which is, what is not included is the amount which is adjusted in the OCI, which shall be reclassified to the P&L, revaluation surplus, then gain or losses from the investments in the equity instruments designated at the fair value, adjustments relating to the PPE, adjustments in the investments, and adjustments relating to the translation differences of the foreign operation. So what have we written over here? Changes in the revaluation surplus, gains or losses from the investment in equity instrument designated at fair value, remeasurements of the defined plan, as well as the, here you should also write the differences, translation differences of foreign operation. Are we clear? So the adjustments which are arising on account of transition to the IndAS from the existing AS is required to be recorded in the other equity at the date of the transition to IndAS. So the book profit of the this year will be increased or decreased with the transitional adjustments recorded in the other equity. Of course, which are recorded in capital reserve, those are to be excluded. And we have to also exclude the amount which I have specified as the adjustments over here. What are the amounts which are to be excluded? These are the amounts which are to be excluded. Are we clear? So, the changes, the adjustments recorded in the OCI, which will be subsequently reclassified to the P&L, because these will be included in the book profit in the year in which they are reclassified to the P&L. The adjustments recorded in the OCI, which would never be reclassified to the P&L, which are basically the exclusion from those items which are changes in the PPE, remeasurements of the defined benefit plan, gain and losses, and the translation of the cumulative translation difference in the foreign operations. Are we clear? So that is to be excluded. So here in this particular case, out of this 52.5 lakh minus 8 minus 4.5 lakh. So basically 40 lakh, out of that 1/5, 8 lakh will be allowed as the transitional difference. So less transitional difference 8 lakh. Yes. Are we clear about this? So what will be my total book profit? Calculate the book profit for me. Calculate the book profit for me. Yes, students. How much is it coming to? Yes. So here transitional difference, sorry, has to be added, not reduced. Sorry. This has to be added. This is add. Yes. So how much is your book profit coming to now? 63.96. MAT at the rate of 15% is 9.594 lakh. Yes, MAT at the rate of 9.549 lakh, 594 lakh, cess at the rate of 4%, 9.97 lakh. Okay. Now tax under normal provisions is 9.2 lakh and tax under MAT is 9.97 lakh. So you will go as per the MAT. Okay. You will go as per the MAT. Yes or no? Namrata, transitional difference, as I said, is basically in relation to the, let's say, for example, you are preparing the books for this year and you are adopting IndAS first time for this year. Now you have to give your comparative financial statements in IndAS. So you are preparing for 23-24. Now 22-23, how will you give the comparative financial statements? Because it will not be comparable to what you are doing with IndAS, because last year you had not done with IndAS. So what you will do is you will make the adjustments to the last year's balance sheet and P&L in order to disclose it as per the IndAS for this year as well. So that's how you will come to the comparative financial statements. So the differences which will arise, those are known as the transitional differences, and that will be recorded in other equity. Now you will include that particular amount, 1/5 of that amount in the book profit. But in that transitional difference, you will exclude any amount taken to the capital reserve or security premium, any revaluations which are done, any adjustments which are done for the investments designated at the fair value, or any adjustments which are done for the translation differences on the foreign operation. Is it clear, Namrata? Yes or no? Is this question clear? As I said, this was a past year question. Okay, so with this, we are almost done with the math. Now there are 2-3 small things which are remaining under the math. So I'm just giving you a quick recap. We had done certain specified adjustments which are required to be done under the math. Okay. And for the IndAS compliant companies, there are certain other adjustments which are required to be made. Are we clear? So for those companies, one is under OCI, second is on the demerger, third is transitional difference, and the fourth is the foreign translation differences on the foreign operation. Are we clear? So basically, the math will be applicable only after you calculate those adjustments to the IndAS compliant companies along with the other adjustments that are required to be made. Are we clear? Yes or no? Yes or no, students? Any question? Any doubts? Yes. Okay. So as I said, now there are few things which are left under the MAT. Now number one is the MAT credit. So under the MAT, there is a MAT credit which is applicable. Now, what is the MAT credit? Now, let's say, for example, as I said, in this particular question, we are going as per the MAT provisions. Now, if you go as per the MAT provision where your MAT is higher than the normal tax liability, so the 115 JAA provides that where the tax is paid under MAT, under 115JB, the excess tax which is there, which is over and above the normal provisions of the Act, which is over and above the tax under the normal provisions of the Act, will be allowed as a tax credit in the subsequent assessment years. So here, this 9.97 minus 9.2, 0.77 will be your MAT credit. Now, this MAT credit which is there is allowed to be carried forward for the 15 assessment years succeeding the assessment year in which the credit is allowable. So this shall be allowed for 15 assessment years. And this credit can be set off against the normal tax payable in any of the assessment year. So let's say, for example, this time you had the MAT credit. Now let's say in the next year, let's say the MAT is, let's say 3.8 lakh and the normal tax is, let's say 4 lakh. This is, I'm talking about next assessment year. Now here, since you have this 20,000 as a difference, this 20,000 will be allowed to you as the credit in the next year. So MAT credit of 20,000 will be allowed. Not entire 77,000. 20,000 will be allowed as MAT credit and balance 57K carry forward to 14 assessment years then. So to the extent of the normal tax liability and the MAT difference, the credit will be allowed to you in the subsequent assessment year. Are we getting that particular point? Now this MAT credit which is there, in let's say case where the company is converted into an LLP, then on the LLP MAT is not applicable. So the LLP will not be allowed the MAT credit. The LLP will not be allowed the MAT credit. Are we getting that? So basically, if let's say for example, there is, what do we say, amalgamation and demerger. If let's say there has been amalgamation or demerger, whether MAT credit will be allowed in that particular case to the amalgamated company or to the demerged company. What do you think? Yes. Where there is amalgamation and the demerger, in that case, whether you will allow the MAT credit or not. Yes, students. Yes, faster. Whether you will allow? Yes. In that case, you will allow it. So basically, when there is amalgamation or the demerger which is there, in that case, you will allow the MAT credit. But where there is conversion of a company into the LLP, in that particular case, you will not get the MAT credit. Are we getting that? So in that case, you will not get any MAT credit. So only in the case when there is amalgamation, demerger, you may get the MAT credit of the amalgamating company, which will be carried forward by the amalgamated company. Although there is no specific provision which provides for that, but it can be carried forward by the amalgamated company. Because all the assets and the liabilities now vest with the amalgamated company. And the similar case will also arise in the case of the demerger as well. So there's no specific provision for that, but one can say since all the assets and the liabilities are being carried forward by the amalgamated company, then in that particular case, the MAT credit should also be allowed to be carried forward. Are we clear? But in the case when the company is converted, that it will not be allowed. So just write down over here. MAT credit not allowed on conversion of company to the LLP. May be allowed on the amalgamation. See, on demerger, it is also very difficult to break that MAT credit because the MAT credit is for the company and the unit of that company is just getting hived off and demerged to the resulting company. So on demerger, it may not be allowed, but on the amalgamation, it may be allowed. Also not allowed to company claiming 115 BAA regime. Not allowed under 115 BAA regime. Clear? So that is about the MAT credit. Now one more important point is the FTC, foreign tax credit, and MAT credit, where both are applicable. Mohammed, I didn't get your question. You are saying the amount should be vice versa of MAT and normal tax. I didn't get it. Can you just elaborate your question? Okay. So let's say, for example, where you have the FTC and the MAT credit. Now, what is FTC? So FTC is basically the credit of the taxes paid in the foreign jurisdiction. The credit of the taxes paid in the foreign jurisdiction. So let's say, for example, if I have some income from foreign country and let's say the TDS has been deducted there. So that is the credit I can obtain in India for the taxes which are paid in the other country. Now, let's say, for example, I have the foreign tax credit and also I have the MAT credit. MAT credit and foreign tax credit interplay. Okay, so I have the MAT credit as well as the foreign tax credit. So let's say, for example, my normal taxes, let's say the tax is 1.5 lakh. Let's say the MAT is coming to 1.75 lakh. Okay. Now I have a foreign tax credit, the tax paid in foreign country, which is 1.6 lakh. Now I'm going as per the MAT because MAT is higher. So I will obviously set off this against the MAT. Okay. So deduction of FTC will be given. So deduction of FTC under section 90 or 91 shall be lower of tax in India, which can be MAT or normal tax or the FTC, foreign tax credit. Here lower is 1.6 lakh, so I'll get 1.6 lakh. Now, excess FTC allowed against MAT. Excess FTC allowed against MAT. See, if I would have gone in normal provision, I would have been allowed 1.5 lakh. If I'm going as per MAT, I'm allowed 1.6 lakh. So because I have the tax liability in the MAT, 10,000 excess is being allowed to me under MAT. My MAT credit is how much? My MAT credit comes to 25,000. Right? So my MAT credit is 25,000. Now, the MAT credit will be restricted the MAT credit shall be restricted by excess FTC. So only 15K will be allowed. Because I cannot claim the double benefit of FTC as well as the MAT credit. So you are saying you allow the FTC also and then you also allow me the MAT credit as well. What would have been my FTC if I would have gone as per normal provision? You allow only that as FTC. If you are claiming the excess FTC, then the MAT credit will get restricted. Are we clear? Any questions, any doubts so far, students? Yes or no? Is this MAT provision clear? Just go through it once again and let me know if you are pretty clear with this. Okay. Now last point under MAT is the MAT, as I said, is not applicable to the certain companies. MAT is not applicable in a case where the foreign company is having the is resident of a country with which India has a DTAA and it is not having any PE in India. Number one. Second, it is not a resident of country with which India has a DTAA, but it is not required to register in India. Third, if the company is offering the profits as per the presumptive sections of 44B, BB, BBA or Triple B. Then, in case of a life insurance company, in case of a life insurance business as well, MAT is not applicable. You can write over here, life insurance business. In case of a life insurance business, the MAT is not applicable. And for the tax paid under 115 BAA, BAB, also MAT is not applicable. Also, what did I tell you for the foreign company? One more thing. For the foreign company, I told you if the income of the foreign company is CG on securities, interest, royalty, FTS, chargeable at the rates which are governed under Chapter 12. Okay. So, if the interest, dividend, royalty or FTS chargeable to tax at the rate or rate specified under Chapter 12, it has Section 115A. And if the income is taxed at the rate lower than the rate under the MAT, which is 15%. If the income tax payable in accordance with the provisions of this Act is less than the rate specified under MAT. Are we clear? So then in that particular case, the MAT will not be applicable. So the MAT on that amount will not be applicable. So capital gain on the transaction in securities, interest, dividend, royalty or FTS, which is chargeable to tax at the rate specified under Chapter 12. And if the income tax is payable in accordance with the provisions of the Act at the rate less than that, then in that particular case, the MAT will not be applicable. Yes, are we clear? Any doubts, any questions? Yes, have you gone through? Shall we proceed further? Yes. Yes, students, any doubts, any questions? Are you clear? Yes, Jigar, it will be available. Mohammed, if the MAT is higher than the normal tax, then MAT credit is available. But in the example, MAT is 3.8 and normal tax is 4. So that's what I said. The earlier MAT credit, which was 77,000 in our example, out of that, 20,000 will be allowed to you as the credit. So in this case, Mohammed, I'll tell you how. So if you look at it, yeah. So 20,000 will be given to you as a MAT credit out of this. So your tax payable for this year will be 3.8 lakh, which is 4 lakh minus 20K. So that's what I was saying. For the next AY, when you are going as per normal tax, you will get a MAT credit of the difference amount which was brought forward from the earlier year, and balance 57,000 will be carried forward to the next year. So this is for, let's say, 23, 24, and this is for 24, 25. Yes, are we clear, Mohammed? Namrata, which question you want to take the screenshot? I'll just quickly, this one, you can take it now. Mohammed, is it fine? Did you understand? Yes, yes or no? Are we clear about this particular point? Okay, so let's proceed then further. Now, in case of the MAT obligations, as I said, remember one thing, understand that whether you are required to calculate the MAT in the question or not. So here, if you look at it, you have to see whether they say ignore MAT or not. So that you have to be very, very careful. Okay. Are we clear? Yes. Okay. Now next is the provisions of the buyback tax. So we are moving towards the next topic. Which one, Namrata? Previous one? Okay. So till we start with the next topic, you can just take the screenshot. Okay. Now understand this particular buyback tax. Now the buyback tax which is there is applicable to the companies which are buying back the shares. Now, what was another provision for the buyback tax, what you have already understood in capital gain? If you remember, we have dealt with this provision under capital gain. If you remember, under capital gain, we have already dealt with the buyback tax. So, can you tell me which provision was that? Yes, students. For the buyback tax, we have done one provision under the capital gain, one section, specific section we have dealt. Yes. Anyone? if you can recollect. Yes, students. Section 46A. So I will take you back to the capital gain chapter where we have done this particular provision. Under the special charge. Buyback of shares. So I told you buyback of shares by the domestic company, either listed or unlisted, is chargeable to BBT at the rate of 23.296%, which is 20% plus surcharge of 12% plus 4% under 115 QE. In the hands of the shareholders, it is exempt. Buyback of shares of the by any other company, let's say a foreign company. In that case, it is taxable in the hands of the shareholder under 46A. It is not taxable in the hands of the company. Do you remember this particular point? Yes. So now we are going to see 115 QA, which is the buyback tax, which is covered under Chapter 12DA. So in case of the buyback of shares by the domestic company, the additional income tax is levied in the hands of the company at the rate of 20% plus surcharge or plus cess, surcharge of 12%. And it is exempt in the hands of the shareholders. Now, what is section 115 QA? So that is what we are going to learn. So under 115 QA, the tax is payable on the buyback, on the distributed income. On the distributed income. Are we clear? Now the tax which is payable by the domestic company. So just write it over here. Buyback tax. Under section 115 QA. Okay. So chargeable in the hands of domestic company on buyback of shares. It is chargeable in the hands of the domestic company when it purchases its own share. Now, what is it chargeable on? On the distributed income. On the distributed income at the rate of 20% plus surcharge of 12% plus cess at the rate of 4%, which makes it to 23.296%. Now, what is the distributed income? Okay, so basically, where the shares have been issued, so these have been bought back. So distributed income means the consideration paid minus the amount received by the company for issue of shares. So consideration paid for the buyback minus the amount of the consideration received by the company on the issue of the shares. Now, how do you determine what is the amount which is received from the shareholders on the issue of shares? For that, you need to refer to the CBDT notification of 2016, which has introduced Rule 40BB. So, this rules provide for the amount received by the company for issue of shares. So, this is the consideration paid on the buyback minus amount received on issue. So where, let's say the shares have been issued by way of subscription. So let's say shares issued by way of subscription. Then the amount received is the amount received including the security premium. So actual amount which has been received. Are we clear? Where let's say the shares has been issued under the ESOPs by way of ESOPs. So then the fair market value of the share, which is credited to the share capital and the share premium account. So FMV of the shares. Fine. The FMV of the shares basically, and how will you calculate the FMV of the shares? You will calculate the FMV of the shares as which was there under the section 17 when you calculate the perquisite taxation, right? In the similar way. Where the shares has been issued by amalgamated company in the course of the amalgamation on amalgamation. Then in that particular case, the amount received by the amalgamating company. Fine. Where the shares are issued on demerger by the resulting company. So then in that particular case, the way you calculate the cost of acquisition of the shares of the resulting company, you will calculate it in the same manner. So amount received by the demerged company, in respect of original shares, into net book value of assets transferred in demerger. So same way you calculate the cost under section 49(2)(c) if you remember, divided by net worth of demerged company before demerger. Same as cost of acquisition under section 49(2)(c). This is shares of resulting company if these are bought back. If the shares of the demerged company are bought back, then in that particular case, the amount received by the demerged company minus this amount, minus the amount of the resulting company calculated above. So same way you calculate the cost of acquisition of the shares for the demerged and the resulting company. Where the shares have been issued as a part of for consideration for the consideration for acquisition of any asset. So in consideration for acquisition of any asset. Then in that particular case, the amount received will be A divided by B, where A is the fair market value of the assets and liabilities into consideration paid by shares divided by total consideration. Okay. So divided by the total consideration, or so A will be lower of this, or the consideration for the acquisition of the asset, consideration through issue of shares. Okay. And my B will be number of shares issued. Number of shares issued as consideration. Fine. Number of shares issued under consideration. Are we clear about this? Clear? Yes. Is this clear? Fine. Next is where the shares have been issued or allotted by way of succession or conversion. So on succession or on conversion. On succession or conversion, if the shares are allotted, then in this case, this will be A minus B divided by C. So A is the book value of the assets minus book value of the liabilities. So basically the net book value, as you calculate even under the rule 11 UA, divided by the number of shares. Divided by number of shares. Are we clear? In case of the bonus shares, since no consideration is received, it shall be nil. Where the shares have been allotted on conversion of debentures or preference shares, then amount received for such debentures or the preference shares. Yes or no? Is this clear? So basically, this is how you calculate the buyback tax. Now, this buyback tax has to be paid within 14 days. If you do not pay within 14 days, then in that particular case, there will be interest at the rate of 1%, which shall be charged to the company. So the interest shall be chargeable for 1% for every month or part of the month on the tax not paid or short paid for the period beginning on the date immediately after the last date on which the tax was payable and ending with the date on which the tax is actually paid. So tax is to be paid within 14 days from the date of payment of the consideration to the shareholders. Now, 1% interest will charge if you do not pay by the end of within that 14-day period. So 1% interest will be calculated from the period beginning on the next month. Sorry, from the period beginning from the next date after the 14 days expire. Okay. And ending when till the amount is actually paid. Are we clear? Any doubts? Any questions? Yes, students. Clear or not? Okay. Now next is the next topic which we are going to cover after the buyback tax is the tonnage tax scheme. The tonnage tax scheme. Now what is tonnage tax scheme? Just write down first, give the heading. Tonnage tax. Now this tonnage tax scheme which is there. Now this is applicable only for the shipping companies. This is applicable for the shipping companies. Now what is this scheme all about? Let's try and understand about this tonnage tax scheme. Now under the tonnage tax scheme, as I said, the shipping companies are given this kind of option to go with this particular scheme of taxation, which is known as the tonnage tax scheme. Now this is applicable, as I said, to the shipping companies. Just write down. Applicable to shipping companies. Okay. So what is this scheme all about? First, we are understanding to whom it is applicable and what is the amount that is chargeable to tax. So a company has the option to compute the income from the business of operating the ships. So this is basically an optional scheme. This is an optional scheme. So a company shall be operating a ship. That particular company is allowed to go as per that scheme. If it operates any ship. Okay, so it can be an owned ship or it can be a chartered, means a rented ship. It can be a charter ship or it can be owned ship. So the company, if it is operating a ship, either by owning that particular ship or on the charter basis. What is a charter ship? Charter ship is basically a rented space in the ship. So there are two kinds of businesses which the shipping company operates is. So they have either the own ship, which is their own purchase ship, or ship chartering arrangement has been entered into whereby the another ship which is there is hired. So ship chartering is basically the hiring out of the ship by a vessel owner to another company. So even if it is chartering the ship, it is not owning the ship. It is not called as hiring. The terminology which is or the jargon uses ship charter. So ship charter arrangement has been entered into. Even that company will be able to claim this tonnage tax scheme. So under ship charter, there are again different arrangements that you can, do a slot charter. So slot charter basically means that you can agree to rent one or more slots in the container ship. Or it is also, there is one more scheme which is known as the space charter. You can basically get into the charter of a particular space in that ship. Whereas in that you enter into an agreement with the shipping company that you agree to basically get the vessel space which is used by the another carrier in exchange for some services. There is joint charter arrangement whereby you jointly do it with somebody else. So a company will be regarded still as an operator of the ship. Are we clear? Now the thing is, as I said, this is the qualifying ship, meaning it is entering into an agreement either to charter or hire a ship, or basically it is owning a ship. Clear? Now in this particular case, the tonnage tax scheme, which is there, is not applicable if it is on the bareboat charter. Bareboat charter means hiring of a ship for a stipulated period on the terms which give the charterer, the hirer, possession and control of the ship, including the right to appoint the master and the crew. So in case, what they do is they hire just a bareboat without any crew members, without any masters in the ship. So if a bareboat hire has been taken, meaning just a boat has been taken, without any space in that boat, entire boat has been taken on hire. So in that case, you will not be considered as operating the ship if it is for a period of 3 years, if the hire has been there. Or bareboat charter come demise kind of arrangement is there, means a bareboat charter is there that you hire the ship bareboat without any master, without any containers. And after that, the ship will be transferred to you after a certain period, which is basically like a finance lease. So in those cases, you will not be considered as operating the ship. So you can write down excluding bareboat charter greater than 3 years or bareboat charter come demise. So this is like finance lease. Option to purchase ship at end of period. And this is without any crew. Charter without any crew. So in those cases, you will not be considered as operating ship. Okay. So shipping companies, including chartering, but excluding this. Fine. So a company will be a qualifying company if it is an Indian shipping company. This should be Indian shipping company. Or Indian or foreign company having poem in India. So foreign company having poem in India, meaning poem in India, meaning this becomes a resident company. Resident in India. Poem in India, meaning it becomes a resident in India. So a company will be a qualifying company if it is an Indian company, if it has a place of effective management in India. And the main object of the company is to carry on the business of operating the ships. Okay. Engaged in operation of ships. So this will be the qualifying company. Now, it should own at least one qualifying ship. It should own at least one qualifying ship. Now, qualifying ship is basically a seagoing ship or a vessel which has a net tonnage of more than 15 ton, which is registered under the Shipping Act. Okay. Now, what are not qualifying ships? So, what are the exclusions to the qualifying ships? Seagoing vessels where they are used for the goods or services. If the main purpose for which it is used is for the provision of goods. Is used for goods or services. Second is fishing vessels, factory ships, then recreational ships, then river ferries, offshore installation, okay. Now, if that be the case, these are excluded. Now, what is the tonnage tax scheme? Now, tonnage tax scheme is a way of computing the PGBP for the companies. This is applicable only to domestic companies, basically the Indian company and the foreign company, resident company basically, not domestic, the resident company, Indian company plus a foreign company having the POEM in India. Okay. Now, how will you govern the profits of this particular tonnage tax scheme? So, computation of tonnage income. So, you have to remember this. Qualifying ship having net tonnage and amount of daily tonnage income. So up to 1000 rupees 70 for each 100 tons. Then greater than 1000 and less than 10,000, 700 plus rupees 53 for each 100 tons. Okay. Exceeding 1000 tons. Then greater than 10K but less than 25K, 5470 plus rupees 42 for each 100 tons greater than 10K tons, and greater than 25K 11,770 plus rupees 29 for each 100 tons greater than 25K tons. Okay. So basically, this is how you calculate the tonnage income. Are we clear? Okay. Yes or no? Any questions, any doubt? So this is, as I said, the optional regime. This is considered as an optional regime. So if a company wants, it can exercise the option over here. Clear? To compute the income in accordance with this particular provision. Okay, so all the deductions will be deemed to be allowed. No other deduction, no Chapter 6A deduction, no set off carry forward of losses will be allowed over here. Okay. And if the company wants to exercise the option, so it has to make the application to the government, to the commissioner. And after the commissioner being satisfied, only then it will be granted the right to opt for the tonnage tax scheme. Clear? Yes or no? Any doubts, any questions so far? Okay. Now this company also is required to transfer the amount to the reserves, 20% of the profit which is derived from the core and incidental activities. So it has to basically transfer this much amount at minimum. And then it has to also require to maintain the books of accounts and get the books of accounts audited. Fine. Any questions, any doubts so far? Yes. Okay, so with this, we'll stop here for today and we will carry forward in the next class. So thank you so much. See you in the next class. You can close the session.